The week starts on a positive note after the US jobs data came in softer than expected last Friday and fueled expectation that the Federal Reserve could start cutting its interest rates later this year. The Bank of England is also expected to give a clearer roadmap regarding its own monetary policy easing plans when it meets this week. In equities, well, the earnings season has been going quite well so far, so robust earnings combined to dovish Federal Reserve expectations could actually keep the risk rally intact, at least until next week's US inflation data. So welcome to the new week of trading with Swissquote's Daily Market Talk. So last week brought a series of mixed economic data and news, but overall the Fed those came out of it with a stronger grip. Because first, the Fed's last Wednesday's decision saw a soothing market reaction. The Fed, or maybe just the media, somehow managed to make the Federal Reserve's decision to hold the interest rates higher for longer look, well, somehow dovish by putting all the weight on just one sentence, and that was that the Fed will unlikely hike the interest rates as a next move. So that was a thing that seemed quite obvious to me and to many, but somehow, I say somehow, that sentence was the biggest winner of all Jerome Powell said, aside like the lack of progress that we see on the US inflation front, for example. But again, more concretely, well, the announcement that the Federal Reserve will finally start slowing the pace of the quantitative tightening was dovish. Then the PMI data from the US showed unexpected slowdown in the US manufacturing, but rising price pressures also attracted attention. The labor unit cost jumped in the first quarter in the US, hinting at more price pressures, but happily, Friday's data from the US came to brighten up the mood as both the non-farm payrolls, the unemployment rate, and the wages pointed at a slowing labor market in April. And in numbers, well, the US economy added 175,000 new non-farm jobs last month. The wages grew less than 4%, which is still twice the Federal Reserve's inflation target, but they are falling, and the unemployment rate rose to 3.9% level versus the expectation of a steady 3.8%. So the Fed won't be in a position to cut the rates right away, but is given a higher chance to do so a bit earlier this year than was expected at the start of last week. So that means that odds for a September rate cut from the Fed rose to more than 67% last week, even though, well, September would be a politically uncomfortable time for the Federal Reserve to start cutting the interest rates, given that, well, the presidential election will be just around the corner in November, and no one at the Fed wants to be pointed at for manipulating the election results. But anyway, that's where we are on the macroeconomic front for now. The US 2-year yield shortly dipped to 4.70% level after Friday's soothingly soft US jobs data, and the US dollar index tested the 50-day moving average to the downside, although the dollar index rebounds this morning as some traders came back to their senses and simply remembered that the inflation leg of the Fed story is far from being resolved. Elsewhere, while the euro-dollar tested the 108 resistance last Friday to the upside, which also shelters the 50 to 100-day moving averages and the year-to-date downtrending channel top. Now, I think that clearing that 108 resistance sustainably will demand a soft inflation read from the US next week. The dollar yen shortly slipped below the 152 level, is better bid this morning, but last week's sharp moves in the dollar yen, which suggests that the Bank of Japan finally intervened to stop the bleeding in the yen, should soften the yen bears' hands, as well they now know that the 160 level is that line in the sand. Cable, on the other hand, is fighting the 200-day moving average offers, but that widening gap between the Fed, which has its hands tied due to a pickup in the US inflation, and the Bank of England, which could actually justify a summer rate cut in England due to slowing British inflation and a morose British economic outlook, could eventually limit the pound's upside potential against the US dollar. Now note that the Bank of England will deliver its latest monetary policy decision this week on Thursday, and there is a growing chatter that the Bank of England could use this week's monetary policy meeting to throw the foundation of a June rate cut in Britain. So if that's the case, we could rapidly see cable give back its recent gains. The latest CFTC data shows that the speculative positions turned negative on pound over the past 2 weeks, and that's certainly on expectation that, well, the Bank of England could pull a dovish surprise from its head this week. And finally, the Aussie dollar is better bid this morning ahead of tomorrow's Reserve Bank of Australia decision. The Reserve Bank of Australia is expected to maintain its rate unchanged at 4.35% level, but the bank could revise its inflation outlook upwards because of domestic price pressures, and also this accompanying statement that could come with the RBA decision will likely deliver a hawkish message, a message that could give the Aussie bulls a further conviction to test the 68 to 70 cents range, with the risk of being stopped out, however, if the US inflation puts the Federal Reserve hawks back in the race. In energy markets, while the US crude hit the $78 per barrel level last week, the near oversold conditions and the dovish Federal Reserve expectations that also back the reflation trade, mind you, could help the price of a barrel recover to and above the $80 per barrel level moving forward. So voila, that's it for the foreign exchange and commodity markets. In the equity space, well, last week's dovish Federal Reserve pricing and also the better than expected quarterly earnings from Apple and Amazon helped the S&P 500 eke out a 0.60% gain over the course of the week. The index closed last week right on its 50-day moving average level. Note that 6 of the Magnificent 7 stocks already reported earnings so far, and their quarterly results beat lofty market expectations. Nvidia, on the other hand, which is the last of the Magnificent 7 to report earnings, is not due to report before the 22nd of May, so investors could, well, enjoy the fact that the earnings season has been fine so far. Beyond the Magnificent 7 stocks, while 77% of the S&P 500 companies have reported a positive EPS surprise so far, according to FactSet, and the blended year-on-year earnings growth rate for the S&P 500 companies printed a strong 5% versus around 3 to 4% expected by analysts. So if that 5% is the actual growth rate for the quarter for the S&P 500, well, it will mark the highest year-over-year earnings growth rate reported by the S&P 500 companies since the second quarter of 2022, where earnings growth rate was at 5.8%. So in summary, the earnings season is going well for the S&P 500 companies. The Fed somehow manages to keep the expectations as dovish as it can, and the technology stocks live up to very, very high expectations. And oh, last but not least, at Berkshire Hathaway's annual meeting last Saturday, the very Warren Buffett said that iPhone may be one of the greatest products of all times, and that Apple is still even better than Berkshire's other wonderful, what he calls wonderful investments like American Express, Coca-Cola and Chevron. But, well, it didn't really prevent Berkshire Hathaway from lowering its stake in this wonderful Apple. Apple, on the other hand, will be revealing its latest products this week on Tuesday, but all investors want to know is how the company is planning to catch up its delay in AI, which will not be unveiled before June. So let's see how Apple reacts to new products, but the major date, the date that you have to save on your calendar is June 10th. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please do not forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.